Hello, everybody, and welcome into this week's episode of the Magnify Wealth podcast. I'm here with your host, Scott Gannon. Today, we're going to be delving into some real estate stuff. So, Scott here has about 12 years experience and education now in the real estate world. So, we're going to be looking at just different ways you can make money in the real estate world.
Yeah, one specific way that there's so many different ways to make real estate or make money in real estate in rentals specifically, and we're going to talk about one specific one today.
Awesome. So the first thing you need to know in real estate is you really need to know your market. Is it one that's around you? Is it a day trips away? Is it a lot further where you have to book a flight if you're actually going to go visit your property? Anything to add there?
Yeah, I mean, this for that matter could be international as well, but right across the country or international, wherever you listen to this, I mean, these strategies apply wherever you are.
Exactly. So, for the purpose of today's discussion, we're gonna assume you know your market, and we're gonna assume you have the proper team around you. Your lawyers, your accountants, your mortgage brokers, realtors, etc. We're gonna assume that all that's already in place before we dive into the rest.
Yeah. So rentals can be separated into. I mean, there's a whole bunch. There's syndications with apartment buildings, or you're buying your own apartment building, or whatever. But there's also, you break it down into what's called the BRRRR method, which is buy, renovate, refinance, rent, and repeat. So those are, you're looking for a gain of some sort in the way of appreciation, really before you really get started. But you can also buy turnkey, and they can be self-managed, or you can manage, or you can have them fully managed. So the idea of a fully managed turnkey and rental is similar to if you bought a business that had a general manager that ran everything for you. So the only thing you're doing is managing the manager. Same idea with turnkey real estate, is you're managing the property manager. That's it. So nothing is 100% passive, but that's pretty close. Okay, so how do you reduce risk with rentals? Well, there's several ways. First, you can get paid in several ways. And second is you're investing in a physical asset. So what does that mean? Obviously, that means that you can see, touch, and feel it. And whether, if you invest your money and things can go completely south, there's going to be value there. It's not like buying a business that could go to zero. You're buying a physical asset that will maintain value. Why? Because it's real estate, period. Yeah, it's real. Yeah, it's a real asset. And thirdly, done correctly, you're going to get a return at acquisition, not after holding. So what that means is, if you buy right, you know what you're making on the way in. So we always talk about that, is you make your money on your way. With real estate, you make your money on the way. Make your money on the way in, not on the way out.
So let's jump back to the first one, and that's getting paid in several ways. So with turnkey real estate, rental real estate, we've uncovered 7 different ways. The first being the cash flow, or the rents.
Mm-hmm. So you want me to speak to that, or you want to list them first and then talk about them?
We'll go with them one at a time.
Okay, so cash flow. So this goes back to that third one as well, about making your money on the way in versus the way out. When you're dealing with rental real estate, especially turnkey that's managed, so you're basically buying a yield or a return on your investment. So that cash flow has to be in place at the start. So what does that mean? That means that we don't buy anything unless it's paying me right away, especially with turnkey. In fact, actually, it's a must with turnkey.
The second way is through leverage.
Yeah, and leverage is, how many people have bought their own house, right? Have you ever paid cash for it? Maybe, yeah, some people have. Some people pay cash for houses, but really, you're likely in at least a 4-to-1 ratio. And I shouldn't say at least. I mean, some people put more than that down, but if you put 20% down on as cash, you can get 80% financed, and that gives you, for the example of a $500,000 asset, you can control a $500,000 asset with $100,000 of your own money. That's leverage, and that multiplies your return right away, because although there's a cost to using someone else's money, it's still leverage.
third method is through amortization.
Yeah, amortization is a cool one. Is you buy a rental property and you have a mortgage payment, but you're not paying it. You're getting somebody else to pay that mortgage, and you're getting cash flow. Again, we'll go back to the cash flow, but the amortization itself does have value. Why? You're paying down a debt on something that you own and don't contribute to paying it down.
Pretty cool, really.
Yeah.
Fourth reason is the one that I think most people, even outside the real estate world, are aware of, and that's the market appreciation.
Yeah, and of course, locally here in the Halifax area, and I guess right across North America, really the last 4 or 5 years, market appreciation has been kind of off the charts. So we've seen a huge run up in market appreciation, and really what we mean by market appreciation is truly that it's not from being able to increase the rent. It's not from being able to make improvements. It's just purely demand driven or inflation driven appreciation.
And speaking of improvements, yes. the next one is through forced appreciation.
Yeah, so forced appreciation, again, that's a huge one with the BRRRR method I mentioned earlier. And but you can certainly have forced appreciation even with a fully managed property. You get in, you buy it, and you draw an income for a couple of years, and maybe you don't spend it, or maybe you just decide, we're going to pour a little more capital into this, improve the property, like maybe you have a move out or something, and you add value to the property just by doing repairs or maintenance, improvements or repairs, and sprucing it up, and you'll get what we call forced appreciation or planned.
And the sixth way you see this income come in is through depreciation.
Yeah, depreciation is a bit of a hot topic. Accountants sometimes don't like to use it. And in fact, a lot of investors don't even use it for the simple reason that in Canada, we have that what's called depreciation recapture on sale. So without getting in too much into the weeds on the numbers on this, depreciation can add value because it defers tax. So, and it certainly does help you avoid tax if your property does kind of lose value or something goes sideways in the way of you put a bunch of money into it to try to improve it and something else goes wrong. There's lots of reasons why I always tell people, and certainly in my world, when I've had rentals, I've always taken depreciation because it does improve the cash flow in that it's what we call a non-cash deduction. So that means, you got $500 a month coming in from a property or $5,000 a month, and rentals are taxed at your marginal tax bracket. On a personal level, corporate level is even worse. Won't get into the tax brackets on this. But the fact is if you have $3,000 in depreciation on a $5,000 a month income, then you're only paying tax on $2,000 versus $5,000. Now, again, you could come back and have to pay that later, but the idea behind taking it, in my mind, is real estate. Don't ever plan to sell it anyway. Buy it and keep it.
Exactly, but the other really important thing with the depreciation side is it's the one of these the points, I guess, that you're not trying to make money from it per se, but you're reducing risk because you're keeping more money in your control today. When something could obviously always go wrong in your life.
Yeah. So if you look at it from a deferral, or you're taking an income from it, you're reducing your tax on it, that money is staying in your control. And if you're afraid of that depreciation recapture, that extra tax when you sell it, if you sell it, then just put it in something else that's accessible and liquid, so that you can use it to pay the tax if and when you sell.
The last way here is inflation.
Now, inflation, I'm going to use an example at the end on this, and what a lot of people that don't really think of this in the way of a real benefit. But if you understand how debt is a hedge against inflation, you can understand that inflation actually can work in your favor when you're investing in real estate. And I'll go into some numbers just as an example later on, just to fully explain that. But suffice it to say, is inflation as a real estate investor, any asset, like it's funny how the government will talk about inflation, like the inflation is negative to people that don't hold assets. If you understand how that works, is if your income's not keeping up, but if you have lots of assets, then you're fine because you're getting asset value. And if you don't hold assets, if you're only like living paycheck to paycheck and renting, you are the one that's going to fall behind in an inflationary environment.
So just to recap, the seven ways are through your rents, through leverage, amortization, market appreciation, forced appreciation, depreciation, and inflation. That's a lot of shuns.
Well, it's funny. It's funny you said that about the shuns. So the first course I took in real estate, I got to tell this little side story, and because he made a bit of a story of it, and don't ever forget the shuns. And that's how he introduced the topic. The guy, the moderator, was teaching, and everybody was just kind of looking at each other. What's he talking about? What's the shuns? You'll find out pretty quick.
All right. So going back to, we talked about how do you reduce risk. The first way was, all the different ways you can make money.
Mm-hmm.
The second way is, remember, it's a real asset that you can touch and feel, which means you can also control its value.
Yeah. So if you're worried, certainly about risk, and you have a physical asset then of the value, then you can improve it. Or in fact, as much as real estate isn't as liquid as cash or anything, you can always sell it too, because it is a physical asset.
And remember, the third reason being the third reason that it reduces risk is, if it's done correctly, you have a return immediately on acquisition, and that goes back to the cash flow, the rent way of making money. Is that you're not waiting for a return and hoping you get it. Is you see it right out of the gate.
Yeah, and this goes back to the cash flow. Like you can be as stingy as you like. You are in control of your own money. So if your mandate is, I'm going to use something ridiculous here, like a 20% cash flow return, well, that makes would be phenomenal, but you'd have all your money that you put into it out in 5 years. But when you think of the leverage being 4-to-1, you'd actually have all your money out in 1 year, which is pretty amazing. Obviously, that's kind of a ridiculous number, but anyway, it's there's ways to take risk off the table right from the start. Just being choosy about what you buy.
Well, taking risks off the table. Let's get in a little more and just keep chatting about different ways you can reduce your risk.
Yeah. So let's just say, it goes back to the 7 ways of getting paid. You have a vacancy, well, you still have appreciation potential, you still have tax benefits, you still have inflation, the hedge against inflation, the debt, so on. And vacancy is not always necessarily a bad thing either. Like in our world here in Nova Scotia, we're under rent caps, and if you have a vacancy, at least for the last few years, a lot of landlords are looking forward to it because they can get the rents back to market because they've been limited during this inflationary period. So is it really a risk? Of course it is. And it can be, if you're vacant for a few months, that could be a real risk. But what is the risk? And you have to decide that. So if you've researched your market well enough, you're not going to want to go into a market that has a high vacancy. So that's a good start right there, is make sure you're in a low vacancy area and that risk is mitigated.
Okay, so what if the real estate prices in your area crash? What now?
Well, again, if you're that part of it is while it's unfortunate and you don't want to see it, it certainly is something you can ride out as long as you have tenants and still paying rent. Like it doesn't, once you're in it, you've got your money in, you've got your rents coming out, you've got a good cash flow, you've worked all that out. don't even look at the value. Again, if it's going to be something you keep indefinitely, eventually it'll be worth more than what you bought it for. That's just the way real estate works. It goes up basically with inflation without any help.
All right. What about what we've been seeing a lot lately, and that's interest rates went up, and now you're at renewal.
Renewal rates. That in this one here, again, this is all about control. So when you first buy, if you're buying at 2 or 3%, 3 or 4 years ago, you're probably, getting a little worried about your next year or two later of your your mortgage term. But again, these are things that can be offset by other things, and that as you still have cash flow coming in, as long as your cash flow is good, you should be able to deal with that. But you also need it's really about determining the term that you're most comfortable with and making sure you have reserves. Every real estate investor needs to have reserves. So even though you're putting, say, $100,000 in that example I used earlier, you should still have more reserves on the side, maybe another 20% on top of that.
So before we spit some numbers your way, the key to remember with what we've gone over on this episode is, as long as you're making money at acquisition, you're heavily reducing your risk, and know that real estate is all about control, and that right there is in and of itself is a huge risk reducer.
Exactly. Yeah. So I'm gonna go run through basically a simple. There's going to be some numbers on that'll pop up on your screen here, but I'm just going to go through a simple example that I use, and this number will fluctuate over time. But in this example, I'm going to use the example of 8% for cash flow. So if you set a mandate that you want 8% from your cash flow, everything else following behind it, you're just going to enhance your return. So in the example of the 8% cash flow, well, if we assume a 3% inflation, then your passive appreciation, your market appreciation, will be about 3%. And so that's 3. And then there's the leverage portion. And the leverage portion is worth 12%. Again, that's the whole, you're 20% down, 80% finance. That's worth about 12%. And then amortization. Year one of amortization of a 5% mortgage is actually 5.9%. So a lot of people complain, and this is, I'm talking about a 30-year mortgage here. So, I mean, you could do a shorter term and you'd have more amortization. But even with a 30-year mortgage, 5.9% of your cash. So what a lot of people think is, oh God, I paid all this interest. I have this $400,000 mortgage and I only pay, I only got whatever it was, say $5,000 or whatever in principal reduction. Well, depending on, actually it'd be $5,900. It works out to actually $5,901 at the end of the first year. So $5,900 divided by $100,000, what you put in, not the value of the property, is 5.9%. So that's an added as well. And depreciation, I put a number of 3% normally on this. It's a lot higher in the earlier years because depreciation comes down over time. But it's worth something, having control of that money for some time. So all those numbers work out to 32.9%. So where can you go and get a 32.9% return and have your risk mitigated? Again, control, see, touch, and feel. It's really all about the asset itself and what it can do. Now, I promised earlier I'd go into an inflation example, so I'm going to use a very simple example here. If you had a property that had $1,000 of rent, the general analysis on this would be you would want a $200 a month profit. So generally, we have about half expenses and half financing. So if your expenses are $400, your financing is $400, your profit's $200. Now, fast forward any point in time in the future, 1 year, 10 years, whatever, rent's now $1,500, and it has nothing to do with improvements at all. It's all about inflation, okay? Now you got a $1,500 rent. You've got a $600,000 of expenses if they go up 50% as well. And I'm even gonna throw in here that your financing does cost a little more. Let's say it costs $500 a month. Well, now you've got $1,100 against a $1,500 rent. So your net cash flow is $400. So what's happened here, if you work out the percentages, you've increased your rent 50%, but your profit's up 100%. Now, does that not mean inflation is looking after you a little bit? I think it is. And with that, that is all about turnkey rentals.
Awesome. Thank you guys for tuning in to this week's episode of the Magnify Wealth Podcast. We'll see you all next week.
Thanks for tuning in to the Magnify Wealth Podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.